What makes this phase especially deceptive is that it feels earned. Markets have been trained through years of intervention, liquidity support, and narrative control to recover quickly from stress. Investors internalize that memory. They begin to assume that stability is a feature, not a condition. But stability is not permanent. It is engineered. And engineered systems fail differently than organic ones. In earlier cycles, risk revealed itself through obvious excess, runaway speculation, explosive price moves, visible euphoria. Today, excess looks quieter. It looks like confidence in models, confidence in liquidity. Confidence that exits will always be available because they've always been available before. That confidence is the vulnerability. When markets function smoothly for long enough, behavior shifts. Hedging becomes optional. Cash buffers shrink, duration extends, paper claims multiply because settlement has become abstract, delayed or assumed rather than demanded. Nothing breaks immediately. In fact, things appear to improve. Volatility compresses. Correlations stabilize. Drawdowns feel manageable. This is the stage where investors mistake absence of stress for absence of risk. But risk does not disappear. It relocates. It moves away from price and into structure, away from headlines and into plumbing, away from public fear and into private balance sheets. This is why late cycle calm is more dangerous than early cycle turbulence. Turbulence forces awareness. Calm encourages exposure. In commodities, especially silver, this distinction matters. Silver is not just a traded instrument. It is a material input. It must be mined, refined, shipped, and delivered. Paper representations can multiply, but physical availability cannot accelerate on demand. As long as the system is trusted, this mismatch stays theoretical. Claims roll, positions net out. Few participants ask for delivery because price exposure is all they believe they need. But systems under quiet strain behave predictably. They continue to function until one assumption changes. Not all assumptions, just one. Liquidity that was expected becomes selective. Counterparties that were reliable become cautious. Timelines that were flexible become fixed. At that point, price is no longer the leading signal. It becomes the lagging one. This is where many investors get caught. They wait for confirmation in the form of volatility or headlines. But by the time volatility arrives, optionality is already gone. The repricing doesn't ask for consensus. It forces adjustment. Importantly, this is not about forecasting an event. It's about recognizing a condition where markets are highly optimized for stability and therefore poorly prepared for deviation, where leverage is embedded, not obvious, where trust substitutes for verification. And in those environments, the first move is rarely dramatic. It's subtle, a small change in behavior, a slight widening somewhere that doesn't make the news, a quiet repricing in a corner most people don't watch. That's why this stage feels normal, and that is precisely why it deserves attention. Because when investors say nothing is happening, what they often mean is that nothing is happening where they're looking. When conditions like this persist, markets begin to send mixed signals. Surface indicators suggest order. Underlying behavior suggests caution. This divergence is easy to ignore because it doesn't create urgency. It creates ambiguity. And ambiguity is where most investors disengage. They defer judgment. They wait for clarity. They assume that if something were truly wrong, it would already be obvious. But systemic risk doesn't announce itself clearly. It tests boundaries quietly, probing for weak points, adjusting flows without drawing attention. This is especially true in markets that rely heavily on confidence rather than immediate settlement. Paper-based systems depend on continuity, rolling contracts, delayed delivery, netting arrangements, and the assumption that claims can be converted when needed. As long as participation remains balanced, this works efficiently. The system appears liquid, even when underlying capacity is fixed. But confidence-driven liquidity behaves differently under stress. It doesn't disappear all at once. It becomes conditional. Certain participants step back first, not because they expect collapse, but because they sense asymmetry. They reduce exposure. They shorten timelines. They ask more questions. None of this shows up as panic. It shows up as selectivity. Retail investors rarely notice this phase because prices still cooperate. Charts still respect ranges. Analysts still explain movements with familiar language. The story remains intact. Yet the behavior underneath is changing. In these moments, risk is no longer evenly distributed. It concentrates. Those closest to the system's mechanics adjust early. Those furthest away rely on price signals that haven't moved yet. This is where timing becomes uneven, not in terms of prediction, but in terms of awareness. At this stage, the most important signal is not movement, but restraint. Markets are still active, yet behavior becomes more deliberate. Participants transact, but with tighter parameters. Risk is not removed, it is rationed. This is where conventional interpretation breaks down. Most investors are conditioned to react to price volatility. Sharp moves trigger attention. Sideways movement encourages disengagement. But sideways markets with rising internal constraints are not neutral. They are compressive. Compression builds potential energy. In stable systems, flexibility absorbs shocks. In optimized systems, flexibility is minimized in the name of efficiency. Over time, efficiency replaces redundancy. Buffers shrink. Optionality disappears quietly. This is not visible on a chart. It shows up in how quickly conditions change when something small goes wrong. A delay becomes a backlog. A minor imbalance becomes a bottleneck. What should have been absorbed instead propagates. This is why the early signs of stress often look operational, not financial. Delivery windows stretch. Terms become less negotiable. Settlement behavior changes subtly. These are not failures, they are adaptations. But adaptations signal constraint. In markets tied to physical reality, like silver, constraint matters more than sentiment. Demand does not need to surge dramatically to create pressure. Supply does not need to collapse, it only needs to stop being flexible. Once flexibility is lost, the system behaves differently. Price stops leading, availability does. At that point, financial instruments still trade, but they no longer fully represent the underlying reality. The gap between representation and function widens. Most participants continue operating as if nothing has changed because, from their vantage point, nothing appears to have changed. This is how normalization traps form. A condition persists long enough that it becomes baseline. Any deviation is dismissed as noise. Explanations proliferate. Temporary becomes structural without acknowledgement. The danger is not ignorance, it's overfamiliarity. Investors assume they understand the environment because it resembles recent history. But systems don't repeat, they evolve. What worked under one set of constraints may fail under another, even if surface conditions look similar. This is particularly relevant for capital preservation strategies. They rely less on growth assumptions and more on continuity assumptions. Access, liquidity, convertibility. When those assumptions hold, almost any portfolio appears resilient. When they weaken, correlations rise and options narrow. This is why the transition phase matters more than the event phase. By the time outcomes are obvious, repositioning is no longer strategic, it's reactive. Early adjustments don't require certainty, they require awareness. Awareness that calm does not equal capacity, that efficiency often trades away resilience, that systems optimized for stability are most vulnerable to deviation. The risk, then, is not volatility returning. Volatility is just a symptom. The risk is discovering too late that what felt normal was actually fragile, and that the margin for error had already been consumed during the quiet period. This is why experienced institutions don't wait for clarity. They watch behavior, not headlines. They pay attention to friction, not narratives. Because friction is the system telling you something is changing, before price is forced to say it out loud. The final stage is not marked by surprise, it is marked by recognition. By the time risk becomes visible to everyone, it is no longer a question of if adjustment happens, but how it happens, and who absorbs it. Markets don't resolve stress evenly. They resolve it through repricing, rationing, or exclusion. This is where assumptions are tested. Investors who relied on continuity discover that continuity was conditional. Liquidity that seemed permanent becomes selective. Instruments that functioned smoothly begin to behave differently, not because they are broken, but because the environment has changed. This is when price finally responds. But price does not respond gently. It responds to reconcile what was assumed with what is now constrained. That reconciliation can take many forms. Sometimes it looks like volatility. Sometimes it looks like gaps. Sometimes it looks like markets that technically trade, but practically don't clear in the way participants expected. For silver and other real assets, this is where the distinction between exposure and access becomes unavoidable. Financial representations still exist, but their relationship to physical reality tightens. Convertibility becomes the focus, not mark-to-market gains. This is not a judgment on any one asset, it is a structural reality. When systems move from abundance to constraint, priorities shift. Optionality is priced differently. Certainty carries a premium. Most investors encounter this phase unprepared, not because they lacked information, but because they misunderstood timing. They expected risk to announce itself loudly. Instead, it matured quietly and revealed itself only when adjustment was unavoidable. This is the core lesson. Risk is not defined by how dramatic conditions look. It is defined by how much margin for error remains. In calm periods, margin is consumed invisibly. Leverage increases. Assumptions stack. Dependencies multiply. Each decision seems reasonable in isolation. Collectively, they reduce resilience. By the time the system asks for correction, flexibility is already gone. This is why the most effective response is not prediction, but positioning. Not reacting to headlines, but questioning what you're relying on. Not chasing safety, but understanding where fragility actually resides. Capital preservation is not about avoiding all risk. That's impossible. It's about avoiding uncompensated risk, the kind that exists only because it was mislabeled as normal. And that brings us back to the beginning. Most investors think this is normal. That belief allows risk to remain mispriced. It delays adjustment. It concentrates consequences. The warning is not that something must happen. The warning is that if something does happen, the outcomes will not be evenly distributed. Those who treated normal as a guarantee will be forced to adapt quickly. Those who treated it as a condition will have already adjusted quietly. In markets, that difference matters, because the greatest risk is not volatility, headlines, or even loss. The greatest risk is realizing too late that the environment changed while you were still assuming it wouldn't. Silver illustrates this dynamic clearly. It trades in large volumes, but much of that volume is financial abstraction. Futures, options, forwards, claims layered on top of a physical market that cannot instantly expand. As long as most participants treat silver as a price exposure rather than a delivery risk, the structure holds. But when even a small percentage begin to care about form instead of price, stress accumulates quickly. And this shift doesn't require fear. It only requires preference. A preference for certainty over leverage, for possession over promise, for function over narrative. Once that preference spreads, even modestly, the system must adapt. Not through announcements, but through friction, longer waits, tighter terms. Change behavior that feels inconvenient rather than alarming. This is the stage most investors misinterpret. They see inconvenience and assume it's temporary. They see calm prices and assume it's contained. They don't realize that inconvenience is often the system's first response to imbalance. Historically, this is where outcomes diverge. Those who recognize the condition adjust exposure calmly, early, and incrementally. Those who wait for confirmation adjust later, under pressure, when choices are fewer. Again, this isn't about predicting a singular outcome. It's about understanding how systems behave when they've been optimized for stability and then encounter constraints. The risk isn't that something dramatic happens tomorrow. The risk is that positioning assumes tomorrow will function exactly like yesterday. In markets, that assumption fails quietly, and then all at once. This is why normal deserves scrutiny, not because it feels wrong, but because it feels too comfortable at a point where comfort has historically been misleading.